Thank you so much. Welcome. We're going to talk a lot about real estate investors and how you can cut your taxes and grow your portfolio. So looking at ways that I think as I was putting this together, I'm like, these things are all really obvious to me, but I realize they may not be obvious to everyone else out there. So I want to take these next 30 minutes or so to kind of walk you through some different tools and leverages that you can take in order to improve your cash flow and reduce your tax liability when you're investing in real estate. My name is Michael Coronado. For those of you that do not know me, I am with Pronto Income Tax. We are a Miami-based accounting firm. We've been in business for over 35 years, and we have clients from Alaska to Florida. And we've been helping folks in the real estate and related industries, developers, contractors, and trades as well. Invest in real estate, run in real estate, and operate efficiently, taking advantage of the different tax credits and options that you have that are very much specific to real estate, and then the other opportunities that you have as the different trades and intricacies that you have within all of those. So welcome, everyone. Right. So if you didn't already know this, the government rewards real estate investment. And in fact, what they're looking at is, and I say real estate investment because that's specifically what I'm talking about here, but really specifically, the government rewards capital, right? So you're looking at capital and how you can grow capital and appreciate capital and make capital gains. In fact, if you notice, capital gains has a lower tax rate than when you are employed. So if you take someone, for example, working at Starbucks who makes $30,000 versus someone who made $30,000 in capital appreciation, the person who made the $30,000 in capital appreciation will pay much lower tax because they're not subject to self-employment tax or payroll taxes, as we're familiar with, so Social Security and Medicare. Just on that basis alone, it's definitely what is rewarded, and you receive a bunch of different tools and ways that you can adjust your income throughout the years that you are investing, especially in real estate, which is what we're here to talk about today. Depreciation being this basic one that a lot of folks know about, which is, hey, if I purchase this property and it costs me $500,000, you don't take that expense in year one. You are able to spread that out over the useful life of the real estate. You're able to depreciate that expense for the depreciating asset. So in the case of a building structure, right? The building is what depreciates because it needs to be replaced and repaired and maintained. And the land does not. The land generally appreciates. The land value of that is not depreciated over that time period. What also occurs during this time that you hold the real estate is that the real estate appreciates, right? So you purchase this real estate and it costs you $500,000. And through, time and time again, we see through the long haul, right? I know there's fluctuations in markets and things go up in value and down in value, but for the long haul, generally real estate values increase. So over this time period, as the real estate value increases, if you want to tap into that equity and borrow against that equity, you're able to do so without paying taxes, which is wonderful, right? So if you purchase the same $500,000 property and 10 years later it's worth $1 million, which is totally feasible that it doubled in value in 10 years, you're able to tap into that additional $500,000 in equity, cash that out of it, right, in terms of a loan or mortgage against that property, and you receive that money tax-free. Why? Because it's to incentivize you to purchase another piece of real estate property or to invest it in another business, because what is being benefited is the appreciation of capital. And that's kind of what happens over the long haul. And so I'm forming this as the basis for folks to kind of see where I'm headed with all of this, right? Why is it smart to invest in real estate? What are the benefits, right? That's an immediate benefit. If you never sell that piece of real estate, you will never pay tax on the appreciation. You can continue to pull on that equity that you have in the property throughout the life. You're paying interest. Yes, you're paying a bank interest, but guess what? Your real estate business, if it's a rental property, is paying the expense, is covering that expense of the interest. And generally speaking, even with today's higher interest rates, it's substantially lower than what most folks' tax rate would have been. So it's definitely a win for the investor in the long haul. All right, I'm going to talk about, I kind of spoke a little bit about this. I started talking about depreciation, and I have here a very simple example of a property, let's say an apartment building. And for the use of this, we're going to say that the building itself, so when I say the property is worth $2.75 million. When you depreciate this and you do nothing else but just say, I purchased the property, I'm going to depreciate it over the useful life, which is IRS has determined is 27 and a half years, you're going to take that depreciation expense against the income that you receive. So let's say $100,000 a year over those 27 and a half years. This is not an actual expense. So from your cash flow, you will still receive 100% of that rent minus your expenses. This is a tax expense, right? So you receive $150,000. Let's say you receive $200,000 in rental income, $50,000 in actual expenses. That brings you down to $150,000. And then you depreciate $100,000. You're paying tax on $50,000, right? Even though you received $150,000. So that's the power of depreciation with nothing else. Now, if we look at this and say, well, gee, I hear about these cost segregation studies. And what are cost segregation studies? Cost segregation studies are an IRS-approved engineering-based analysis. So it's looking at the structure and saying, this is what these different components of the structure cost. And some of these components have a much shorter useful life, right? So we're talking about depreciation, you depreciate over the useful life. If you start segregating them out, cost segregation, and you segregate what's the cost of each of these individual components, you're now able to accelerate that depreciation over a shorter lifespan. So for example, appliances, that's a really simple one. Appliances useful life is 5 years. So over 5 years, if you figure out you have multiple apartments, the appliances are $2,000 worth of appliances per apartment. And there's 5 apartments, that's $10,000 that you're depreciating now over 5 years, $2,000 a year, versus the entire, if you did that over the 27 and a half years, it wouldn't be a rounding error. So that's the benefit of a cost segregation study, is to be able to move those things that would have been otherwise depreciated over the entire useful life of the whole structure, but just for those individual components. Another useful case for cost segregation studies are that you're looking at the fact that when you purchase a property, sometimes you have an appraisal, and sometimes that appraisal calls out the land value for that for the purchase, and then you look at what is the building value. And those are just guesstimates based on what is happening in the market, but there's not the real cost. So when you do a cost segregation study, an engineering study, an engineer goes and looks and says, no, really to replace this structure would be substantially more than what was in the appraisal report. And that's important because if you're depreciating a property, you only depreciate the building structure, right? We talked about this at the beginning. We're talking about just the building. So now if the land value is too high, there's less money for you to depreciate over the useful life. But now if the land value is lowered for tax purposes, right? We're not talking about appraisal, we're not talking about the real value, we're talking about for tax purposes, because that's what we talk about, the cost segregation is IRS approved engineering based analysis. And it says now the value of this property, or the cost of this property, is substantially higher, then you're able to take advantage of that, right? So for every $27,500, it means another $1,000 a year at the simplest of places, right? But if we're talking about foundation and structure and roof, but if we're talking now individual components, there are others that can be shortened, as we mentioned earlier, appliances being a great example, I would say. So basically, things that are shorter term, because I'm sure folks will have questions about this, tend to be items that are not permanently affixed to the building. Things that are closer to 15 years are things outside of the building. So you're looking at like landscaping, parking lots, fencing, and then the structural elements, actual physical structure, are things that tend to do over the long haul. So roof, the foundation, the actual plumbing, not the fixtures, but the plumbing itself. That's useful life generally for plumbing is over those 27 and a half years. So you look at this and say, well, gee, this is great. We should be doing this. What are some cons? Well, some cons of the cost segregation study are obviously that by depreciating it earlier, if this is a property that you decide to sell in the future, you now have a lower, so you've already taken a discount. You have to recapture that depreciation, sorry. So you've taken that as from discounting the price. So now your profit from a tax perspective is much higher. And then of course that's when you look at other mechanisms and other levers that you can pull to lower the tax basis or decrease it over time by just delaying it, right? This is what we're doing, we're just delaying when do we pay tax, right? So the feature of this is how do you delay this into the future. All right, and then that brings me to my next one, which we'll start talking about. Well, gee, I've done a cost segregation study, and I hear that if I haven't done a cost segregation study, either way, I've purchased a property, I'm selling it for much more than what I purchased it for, and in South Florida in particular, over the last 5 years, it's a lot of folks maybe even doubled their money, and they're looking, well, gee, what do I do in order to avoid paying taxes right now at the moment that I sell this property? Well, in comes a 1031 exchange, and it's basically allows you to swap paying the tax now to pay it down into the future. There are some options with a 1031 exchange which will allow you to pool out some of the money and pay tax now, and then just push out into the future. Because always, the thought is, the older one gets, the lower your income is, the lower potentially your tax rate will be over the long haul. So you're looking at a 1031 exchange and saying, gee, I don't want to pay the tax now because I'm fully employed, I make a good amount of money every year, and I'd rather pay that in the future. Or in fact, I was actually just going to take this anyway and buy another property. Now you can do that tax-free. And what that allows you, if you would have paid, for example, on a $100,000 profit, let's say $30,000, you would have paid 30%. That would have meant you would have only had $70,000 to do something else with. But if you roll it into the next real estate transaction, you're able to take that full $100,000 into the next real estate. Whereas opposed if you did something else, you would be able to do that. There's some rules and some regulations about when you have to decide that. You have to identify the property and how quickly you have to close. So there's some intricacies that make it not as good of an idea for some folks. There are some alternatives, and I'll talk a little bit about with kind of my next thing about doing how you could potentially do what I'll call a baby 1031, which would allow you to not do a formalized 1031 through a 1031 program that has all these rules, but as long as you sell a property and buy another property during the same tax year and take advantage of some of the bonus depreciations and things that you might be able to take, you're able to do that kind of in the next year. And that kind of leads me into the short-term rental loophole. Well, if real estate is not your primary business and you do not have a real estate professional status, or reps, as you'll hear me talk about, you can accelerate and gain bonus depreciation through short-term rentals. So, Big Beautiful Bill actually extended, because it was previously shortened. It was previously going to be sunset, the ability to accelerate it and take advantage of this bonus depreciation. And so what they've done is they've codified the fact that if you have a short-term rental, you can offset W-2 or business income, or in the previous example that I was talking about, a baby 1031, you could do the same thing, achieve the same result without all of the rules and intricacies of 1031 and having to go through that. So if you have W-2 income, you say, well, gee, that's not me, I'm not selling a property, but I do have substantial W-2 income. Short-term rental is a good place for you to consider investing money, because you will lower your tax basis for your for that year. So you're able to offset it, because you can say, well, I made multiple six figures this year, and I purchased a short-term rental in the Panhandle, right? In Destin, I purchased a short-term rental that I'm going to rent out. And I'm going to be profitable in it from a cash flow perspective, but from a tax perspective, can we? Because it's less than 7 days on average, and that's your material participation, because you're renting, responding to folks and renting it out. You can actually lower your tax basis. In fact, we've done that for. I had here a case of a client who was able to lower their tax bill by $52,000 by lowering their total taxable income for the year, because they took advantage of the fact that short-term rental benefit, right? So the short-term rental loophole, as we kind of talked to about it. That's why this becomes more and more popular, and we see buildings popping up that are just fully short-term rental only, right? And because people want to jump in on it they think there's money to be made, but there's also some tax benefits. Obviously, don't go into it just for the tax benefits. It should also make some sort of financial sense as well. And I know that with all of these topics, I'm just touching kind of the tip of the iceberg, but at least hopefully this gives some good ideas of what are some things that you could do, and some ways that you can actually save money and invest in real estate and appreciate capital and have it continue to grow over your lifetime. Well, there's some other advanced moves that you can make when it comes to real estate investments. And you've heard about opportunity zones. And opportunity zones are basically zones that were designated where if you, and there's funds actually that you can invest these dollars that you've made selling your real estate, you can pull it into these opportunity zone indicated properties. They tended to be more urban, but with the Big Beautiful Bill, it's actually been increased. So now there's some rural areas as well, and basically it allows you to invest in areas that the government thinks they want to see grow. So rural and potentially some urban areas as well. And so now you're able to make these investments, defer and in some cases actually exclude the gains that you've made by investing in these properties and opportunity zones. I mentioned about short-term rentals, and that's a shortcut for real estate professional status, and really that just allows you to get the bonus depreciation and accelerate depreciation to go against the income that you may have had in that tax year. There's another one. If you're leaving a W-2 job and you are no longer at a W-2 employer, you have the opportunity to invest your hard-earned retirement money that might have had even some employer matching and all of that through a solo 401k. If you have your own LLC, you can set up a solo 401k or a self-directed IRA. And so through these accounts, you're able to now use this retirement funding. So if you've, over the years, if you have $300,000, $400,000, $500,000 saved up in this account, you can now take those funds and directly purchase real estate. I'm oversimplifying, but you could purchase real estate. This real estate transaction can have a gain. Let's say you sell the real estate at a gain and you pay no tax, because you pay the tax depending on a solo 401k or IRA when you withdraw the funds from the account. If it's in the case that it's not a Roth, right? Because a Roth, you prepaid the tax. Now this money grows tax-free, and you pull out all of that appreciation tax-free. So it's a smart way to use this money that's tax advantaged already and direct it towards real estate, and those are just two other options that you could kind of look at for that. I have here a quick case study, and we had a client who came in who had purchased a $6 million multifamily, and we looked at it, and they were paying about $300,000 in taxes. So it was a high income earner, but they had this real estate investment, and they looked at, what can we do to lower our tax bill? And because of the fact that they we weren't trying to get the tax bill to zero, because they were someone who was expecting to have this income on an ongoing basis. So we wanted to make sure to set up a smart plan where this depreciation would continue over many years. So we used a cost segregation study to be able to identify the things that we could accelerate to the more useful life, 5 years, 7 years, and 15 years versus the 27.5 years. We lose bonus depreciation because this was a short-term rental. But had it not been, and in their case, if their spouse had been a real estate professional, that would have also been a case where that would have gained them the real estate professional status. That's why a lot of folks you might hear are just real estate, have realtor licenses or mortgage broker licenses, and it's because their spouse might be high income earners, and this allows them to offset the depreciation without having to invest in short-term. But in this specific case, it was a short-term rental property. We also looked at ways of having a management entity that allowed for those fees to come through as an S corporation instead. And so at the end of the day, for this specific client, they had purchased $6 million property. They were paying $300,000 in taxes, and they were able to lower their tax bill to $75,000, which I think was an incredible savings for them. But more importantly, for just the 1 year off, we had this tax plan of how we thought income was going to continue throughout the next couple of years, and how we were going to offset that income because of the structure that we set in place, because of the cost segregation study, and because of the bonus depreciation. All right. Well, I went kind of fast. I went faster through it than I thought I would. So hopefully I left some more time for folks who have some questions and things of what they want to talk about. But, as I mentioned, we talked about depreciation and cost segregation and the advantages there, right? Depreciation, useful life, cost segregation lets you increase how much things you depreciate over the actual useful life. So it tends to be shorter. 1031 exchange allows you to pay delay paying the taxes, because you're delaying it to the future, because you're exchanging out the profit into another like-kind property. And there's a bunch of rules and intricacies of that, but there are definitely some benefits there. There's also the short-term rental loophole, which allows you to do the bonus depreciation if you don't have the real estate professional status or reps. Like I mentioned, that sometimes folks have their significant other. And then we talked about advanced moves for opportunity zones and in those areas that have been done. And then as well as the solo 401k and the Roth IRA. But with that, I will open it up to questions. I see, Edward, you have a question.